Are you concerned we could be heading into a stock market crash and you're not sure what to do? Are you afraid you could be losing all your money and you're wondering if you should be cashing in? So I'm going to go over what I think Warren Buffett would do so you can be confident during the stock market crash. So let's jump right in.
When you buy a stock, have it be down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out 3 times in Berkshire's history when the price of Berkshire stock went down 50%. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others.
Most of you can agree that Warren Buffett has immense investment success during his long career. He is one of the best known fundamental investors ever and is currently 7th richest person in the entire world. He has mentioned in this clip that his current company has even dropped 50% at times, so he says not to focus on the dips. He believes the best time to invest is during a crash because you can buy things at a discount. These are the best times to get wealthy. The reason for making this video is so that when the market eventually crashes, and it will, you'll be confident in your investment decisions.
You never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I never felt that I knew it, and I've never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
You see, Warren understands that it's not about timing the market, it's about time in the market.
We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm.
Day traders will also have a long-term investment plan. They will look at investing into funds such as VOO. VOO is Vanguard's S&P 500 index fund, and it currently tracks the 500 largest companies in the US. In order to become successful in the stock market, you want to go into it slowly by dollar cost averaging, and you want to invest regularly and consistently over the long term. If the stock market crashes, don't think about the money you could be losing. Investing for the long term will have dips, which is expected. Just focus on buying during the dips because you're buying things when they're on sale.
Bad news is an investor's best friend. It lets you buy a slice at a markdown price. Predicting rain doesn't count. Building the ark does. Market turbulence is inevitable, but it shouldn't sway you to flee from the chaos.
If you're the type of person that buys individual stocks, make sure to listen to this next clip. Warren will discuss the mistakes he's made in the past and how important it is to buy companies that you understand.
I have an old-fashioned belief that I can only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do. I understand the economics of it. I understand the competitive aspects of the business.
So this is where investors get it wrong, because they buy a stock because they see it as being cheap, but they know nothing about the company and they haven't done their research. So don't buy a stock because someone told you to buy it. Buy it because you believe in this company and you see enough of an upside to make a lot of money.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, say, in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy a wonderful business. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
So as Buffett mentioned, buying used cigar butts or companies that may be struggling or IPOs, initial public offerings, so new companies may be very enticing. So it's all about investing smarter, not harder. Buffett believes you should be investing in wonderful companies at a fair price. So I'm going to leave you with one last clip from Warren Buffett, and he basically explains how you should be doing the opposite of what everyone else is doing.
People behave very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited. They get greedy when others get greedy. They get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime and securities markets. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. Investors behave in very human ways, which is they get very excited during bull markets. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for a huge opportunity, just huge opportunity.
You see, the vast majority of people who invest in the markets follow the trends. It's harder to invest when times are bad because you're essentially doing the opposite of what everyone else is doing. Now, if you can invest during this panic time when the market is down, this is your opportunity. So you want to be greedy when others are fearful and fearful when others are greedy. So we're all in this together, and I hope you guys enjoyed this week's video. So make sure to subscribe and like. So I will see you guys next time.